Hey you guys, I'm Phil Town from Rule 1 Investing, and today I'm going to give you 10 commandments for successful investing. Hey, if you're not sure where to turn for investing advice, why not learn from the most successful investors in the world? Wouldn't that make sense? So these are the rules that Warren Buffett, Charlie Munger, Ben Graham, myself, all do our best to live by. Okay, guys, the first commandment is to stay rational. Ben Graham said, buy not on optimism, but on arithmetic. And this guy knew what he was talking about. He taught Warren Buffett how to invest. And Graham made 22% a year during the Depression and World War II by staying very rational. What that means is recognition that emotions are very, very alive in investing real money. Okay, so we want to let you just understand, don't let your emotions get out of hand when you're trying to invest. You got to recognize you're going to experience greed when things are going up, and you're going to experience fear when things are going to go down. So we're going to show you the other commandments are going to help you keep these emotions under control. Second commandment is stick with what you know. Peter Lynch said, know what you own and why you own it. All right? So we want you to focus your attention on industries that you're already comfortable with, things that you're already spending your money on, or places where you're making your money. Imagine you were going to have to own and operate the whole business. Understand the business that you own. Third, do your homework. Warren Buffett says never invest in a business that you can't understand. And believe me, the homework is significant here. You're going to want to really dig in on these companies, and you're going to want to go through a process ultimately where you decide, wow, this is a really great business. And then Charlie Munger says, invert the argument, turn it upside down, and argue that the business is terrible. And if you can talk yourself out of it, then it probably wasn't a good investment. You should know the business that well, what you're buying. Know that company from the inside out. Fourth, love what you own. Love what you own means you should attach your values to the business that you're going to own. You want to put your money where your mouth is. Basically, we talk about this is all we have, this thing that we value. But we go out and put our money into mutual funds, and they buy whatever's out there in the market. It doesn't matter what the values are of the company. Most of us have really good intentions to make the world a better place, right? But we seem to forget that the businesses we invest in have a direct impact on what's going to exist in the world in 20 years. It's really something when you start to think about investing as a means of voting for your values. So put your money where your mouth is. Fifth, the CEO should be trustworthy and transparent, okay? We like people who are talented, obviously, but integrity is so critical with a CEO, and we want to make sure that transparent means they're going to tell us what we need to know in order to understand the current value of that business. If you want to see what a good CEO should look like in terms of transparency and trustworthiness, go read the letters from Warren Buffett at Berkshire Hathaway. Just Google Berkshire letters, and you can read them every year back 35 years. That's how a CEO should behave. If your CEO isn't acting like that, you may not want to put money with them. Sixth, always buy a stock when it's on sale. In order to make sure you make money on a business, you got to buy it with some kind of margin of safety, you guys. You can't just go out and assume that the world is just going to continue going the way it's going. There are, as Charlie Munger says, you must have a margin of safety to account for the natural vicissitudes of life. Vicissitudes, or something like that. I don't know how to pronounce it, but the ups and downs of life. Now, to ensure you make money on a business, you want to buy it at half of what it's worth, okay? So in order to figure out what it's worth, you got to know how to value the business, which means you have to understand the business, and then you always strive to buy that $10 of value for $5. That's critical. Seventh, always remember that the price of a business is not always equal to its value. Sometimes the value of a business is much, much higher than the price, and sometimes the price of a business is much, much higher than the value. So you guys just always strive to find companies where price and value are not the same. When price gets way too high, we sell. When price gets way too low, we buy. Eighth, when do we buy? Well, we buy when there's fear, and we sell when there's greed. Seth Klarman had this to say about buying fear in the stock market. He said, generally, the greater the stigma or revulsion, the better the bargain. In other words, When they really hate it, then it's really on sale. You should be fearful when others are greedy, and you should be greedy when others are fearful. That's Warren Buffett 101. When the market begins to go down and the price of that stock starts to drop, greedy investors get out quickly to avoid their losses. But if the company is really a good company and you understand it, that's when you can take advantage. The ninth investing commandment, and one of the most important, if not the most important commandment, is to be patient. It's okay to wait until conditions in the stock market are just right. You don't have to do something right now. Investing for the long term means buying companies that you know are going to be around in 10 years and getting them when they're on sale. And to do that, Lou Simpson said this: you have to be patient. In many ways, the stock market is like the weather, in that you don't like the current conditions, all you have to do is wait a while. I think that's really what he meant as the weather in Jackson Hole, Wyoming. So wait until you're comfortable and wait for the deal to be right. Charlie Munger said, you don't make money when you buy and you don't make money when you sell. You make money when you wait. 10th, learn to invest on your own. You just got to do it yourself. There's no one that can do this for you. And you probably aren't getting the returns you deserve by having somebody else manage your money anyway. And you definitely don't know what companies your money's invested in, so who knows where your values are being bet. Nobody cares about your money as much as you do. Nobody. So make your own decisions in your own best interest with your own values and not in those of your financial advisor or your mutual fund manager. Warren Buffett makes decisions based on what he loves, what he values, what he needs in his portfolio, not the needs of financial advisors and stockbrokers, you guys. So I'd love to hear from you guys. Do you stick to these rules? Do you have any of your own that you think are even better than this? So leave a comment below with your answer and I'll be sure to follow up with you. So I want to thank you for watching. Now go play. If you guys enjoyed this video and you thought it was valuable in teaching you more about investing, please just subscribe to my channel. It's great. And we'll share this video with you and your friends anytime you want, and anybody else that might want to benefit from this information.